you. Today is Thursday, January 15th of 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. And to provide today's context, I'll continue sharing my observations on the London Stock Exchange. It's a listed company I'm following, which is undergoing a restructuring and refinancing process. And using this company as an example, yesterday I talked about digital sovereignty as a mode and why boards need evidence and not just positioning. And today, using the same company situation as an example, I moved to the lever that makes the whole recovery plan believable, not by is viable, but more believable. And given the company assets or assets are trapped, today's um, comment would be about productization. So let's separate two things with that boards often bundle together. So one is efficiency and the other one is scalability. And you say, what it have to do with productization? Has a lot to do, particularly with this company. And perhaps it's something that you can scoop from this in terms of what is going on in your company. And you will say, oh yeah, we can do that too. So efficiency is doing the same work with slightly less cost. But when we talk about scalability, it's producing more value without needing proportional more people. That's why we're talking about productization. And in a restructuring window like this company, markets are not paying for a slightly better. Yes, they are paying for the structurally difference that they are going to go through. So there are three problems with this. Number one is the UK's own capital pattern shows where scalable value concentrates. And this is coming from the National Statistics report that the investment in intangible assets exceeds tangible investment in 2023, with software as the largest capitalized intangible category. And this is coming from the latest reports or stats. So when software and organization capital dominates investments, boards should expect margin recovery to come from products and systems, not just the low or cost reductions and the takeouts. And problem number two is that regulated clients are subject to operational resilience expectations for key business services and impact tolerances. And this is a Prudential Regulatory Authority, PS 621 sets. Which sets expectation that firms prepare to remain within impact tolerances in several but plausible scenarios. So suppliers who cannot deliver consistent standardized resilience become harder to retain, especially during restructuring. And problem number three is that customer trust is increasingly tied to product-grade security and resilience, not service promises. And this is in the UK government's software security code practices. There are 14 principles vendors are expected to implement as a baseline. So you already have your baseline, 14 principles coming from the software security code of practices. So if you're shifting from service to products, the bar for security, update discipline, and supply chain resilience rises immediately. You already have a code there and a set of 14 principles. So in simple terms, a labor-led turnaround is like trying to raise the ceiling with standing taller, but the productization is rebuilding the whole room in the right way. So now here is a nuances that makes the case useful for any public listed company. Particularly taking the example of this one I'm observing, they have a real IP in its higher value digital and security state, but much of it is still delivered as a service. It's not productized, which means that the economics stay trapped because it's delivered as a service. So if the IP is bundled into bespoke delivery, revenue scales with people. So you need people to scale with that IP. But if the IP is separate into the product modules, revenue start to scale with adoption, right? So the separation here is the board's job to force. And force seems to be a hard word, but actually is very convenient in circumstances appropriate, I would say, because management will always have reasons to delay it or push back. So they know that there are client complexities, which is real. There are legacy contracts, which is very real. Consulting utilization, you say, well, we have a product and well, we need a consultant. Well, we need a consultant because otherwise the products. Short-term revenue fear, because actually this is a transition. So all this is very real. But the alternative, I'll say that is worse. A plan that assumes structural margin lift, right, without a structural model shift. So as a board advisor, what I would propose to consider in this case is the following. Number one, run an IP audit with the product intent in mind. So identify specific modules in the digital and security state that you can be decoupled from professional services and sold as license software or software as a service. And remember that the UK of National Statistics picture of intangible investment is a reminder that software is where scalable value is rewarded and defended. It's not only rewarded, it's defended too. Suggestion number two, productize the delivery method into a system asset. So convert the legacy turnaround into repeatable standardized operation procedures through automation, controls, and monitoring. Operation resilience expectations push regulated clients to demand repeatable and evidence, or repeatability and evidence. You cannot evidence resilience at scale if delivery is bespoke every time. And when I mention regulated clients here is because I'm thinking that this company that I'm serving in the London Stock Exchange has a very, very healthy government contracts and bids install base. So they have a very large part of the revenue coming from government contracts. That's why I'm talking about regulated contracts. But also private engagements are highly regulated too. So it works for both. But I'm thinking mostly on part of the government contracts. And suggestion number three is to change incentives from sell work to sell repeatability, but keep reporting clean. If you introduce annual recurring revenue and other recurring metrics, boards should require cleaner definitions, reconciliations, and consistent with the application performance monitoring expectations, which is the APM. Now, that particular last point is where boards can add immediate discipline. And remember, discipline is not a punishment. It's like a behavior or the swimming lines, if you may. So productization programs often fail because the incentives stay service shaped, right? So you're still depending on people and bespoke delivery rather than a repeatable software licensing. So teams optimize for total contract value, they sell complexity, they protect billable hours, and boards should flip that weight into reward recurring high margin outcomes, reward adoption, and reward reduction in manual touch from bespoke to software licensing. So don't let the metric become a story. So define exactly what is the annual recurring revenue properly, reconcile it, explain the movement, and keep it consistent period to period. And that is how you keep credibility while you change the model. So remember, this particular company I'm using as an example, but this example can be deployed anywhere else, is changing from people service shaped deliveries to productization repeatable programs or licensing or software as a service. And why this approach matters? For three things: the outcomes, differentiators, and risk reductions. The outcomes is the UK's investment reality supports the direction, right? Intangible investments exceeding tangible investments, with software as the largest capitalized intangible, reinforces that product and system assets are where scalable margins are built. As a differentiator, the Software Security Code of Practices gives boards a concrete checklist to move from service brand to trusted product brand. This is a practical way to protect the brand asset while you shift the revenue mix. And how it helps to reduce your risk. Operation resilience expectations serve as an external forcing function for boards. If key clients must evidence resilience against impact tolerances, suppliers who can standardize delivery and prove controls, that becomes a strategically sticky situation for the clients. So that is how productization links to retention and not only margin. So what feels like the best next step for you today? Particularly if you're in a board, or do not approve a generic digital transformation program. Do not ask for a new organization chart, but start with a test. Ask for a productization proof pack, right? And this is one action. It's very simple. Ask your management team for one page only view of the and of listing of 5 IP modules to be carved out from into products, the security core principles to be met, and the 2-quarter targets for recurring revenue and delivery automation. Now, you say one pager for this is a bit too small, but actually that will condense the thinking that is this doable or not, or how we're going to make it and how we're going to measure it. If that one pager turns into we are exploring, well, I guess that you have your answer. The model is still service-led. You need people to continue generating revenue for your organization. It's not productized yet. And if you are in the executive team and your board needs to decouple growth from headcount without losing trust with regulated customers, and we mentioned regulated customers, book a structured diagnosis session with your own team to map IP to product candidates, operation resilience evidence, and KPI definitions that markets will accept. So I think that we can pause here today and reconvene tomorrow, because tomorrow I will show you why none of this matter if working capital keeps collapsing, because cash failures usually arise before the P&L admit it, right? So if you're interested to have a chat with me, just ping me in LinkedIn and we have a Zoom call. We understand what is your position, what you're looking for, what you need, and from the advisory position and helping you to put together an advisory board, we'll see if we can help. Right. Thank you very much and see you tomorrow.